While the economy was slowing for the second half of 2024, the markets thought Trump 2.0 would lead off with some pro-growth and pro-deregulation in November of 2024 post-election. Those thoughts quickly morphed into a second half of February through last week's bear market sell-off and the thought of a potential growth collapse. The markets had already corrected minus 10%, which is quite normal in the first year of a presidential cycle, and the first half moved down due to economic slowing. This slowing had been ongoing since last July, but had slowed more post-Christmas into the new year. Markets were pricing in about 10% across the board global tariffs into Liberation Day. The Navarro plan that was presented was nothing like anyone had seen, and it appeared to be drawn up on the back of a napkin a few hours before the president's speech. The bad news is that the tariff announcements were far worse than expected, causing a sharp drop in the market. The Trump calculation substituted goods trade deficits for tariffs. I'll drop a link to the last week's video on the topic in the description below. Frequent followers know that I'm a student of market history. While I'm still under 60 years old and have experienced a number of major economic cycles, stock market crashes, and bull market runs, I haven't experienced anything like this, ever. But those kinds of historic studies helped Oak Harvest Financial Group's clients be guided and almost universally not panic during the COVID market collapse as our team studied the historic pandemic response to the 1918 Spanish flu. We studied the ebbs and flows of prior virus, what our leaders did to stimulate the economy, and what the financial markets did back then as well. Remember, the public financial markets are the summation of collective behavior of investors. Investors are human, and regardless of whether you're Generation Boomer, Gen X like myself, Gen Z, Millennials, or others, humans tend to have similar behavior and emotional responses time and time again. Financial emotions ebb and flow from greed to fear and back again throughout our lives, throughout economic cycles, and hell, during weeks like last few, even day to day. So investors, why did I title this episode? Sometimes you just have to close your eyes and buy, and sometimes you just have to smile and laugh. I want you to sit there and think back to almost the entire universe of financial profits that we're saying and spewing just less than 6 months ago. What were the headlines back then? U.S. exceptionalism. The U.S. was the only financial market worth investing in. The dollar was too strong, and interest rates would rise due to the economic stimulation of the new White House. People were dropping that term around because, unlike most other countries, investors' money had been treated best here in the United States. We have rule of law. While we do have government interference and regulation in our economy, it tends to be much less than in other areas of the world. Overall, investors enjoyed less friction in their investments, and business owners enjoyed less government interference for decades. And then the Trump tariff plan hit, however poorly it was structured and initially implemented, and in the span of 3 or 4 weeks, the U.S. and its financial markets went from exceptional to toxic in the minds of strategists and global investors. The dollar went from too strong to a joke. Our treasuries went from safe haven to lit dynamite that investors were tossing around so as not to blow themselves up with. The U.S. technology stocks went from the bride of the ball to uninvestable in just a few months. Take a look at last year's chart for the S&P 500. It calmly went up and to the right into the election, a little short-term euphoria right after, and even though the data was saying the economy was already cooling and on the way to having a growth scare, a normal, earlier pullback into first quarter earnings cuts, and then wham! Navarro drops the global reordering trade and manufacturing bomb on everyone. The U.S. goes from relatively smooth and orderly rules to where we are the friction capital of the world. Trade barriers were imposed, walls lifted, rules changed, and business had had a week to figure it out. No wonder the markets tanked and earnings visibility vaporized overnight. Revenue visibility vaporized at the same time, and costs looked to have increased. Hedge funds and other traders and investors on margins blew up and were forced to sell. At what price? It doesn't matter. Those are the rules of the game. This got me thinking, have I lived through a prior period looking like this, resembling this time? My first thought was, of course not, as history never repeats exactly. I don't think that a president has ever tried sweeping global trade reorganization like this since the 1930s. But for the last 2 years, my mind has kept coming back to the dot-com growth period in our current AI investment cycle. Dot-com was the internet build-out, the generational technology change in CapEx investment from 1995 through 2000. This was a period of decent economic growth, followed by a tightening cycle in the mid-1990s, a pause by Alan Greenspan around 1996, a soft landing, a thrown-in short-term financial crisis in the middle in October of 1998, which was then long-term capital, and then another 2 years of growth as the Federal Reserve eased interest rates. So I want you to look at the chart of the S&P 500 during the first half of the dot-com build-out from 1997 into long-term capital in October 1998 and then onward. This is the overlay with the current AI CapEx build-out into last week's volatility shock and mass hedge fund liquidation, into the market's run towards safety and cash and gold, and out of stocks and bonds and other risk assets. I know you're saying to yourself, Chris, this time it's different. Maybe it is, but so far, it looks and feels a lot like it did back then. Back then, the S&P 500 dropped about minus 22.4% peak to trough in about 2 months. Global uncertainty and hedge fund blowups happened and forced liquidations as well. The S&P 500 has currently fallen almost exactly the same percentage peak to trough using intraday highs and lows. Hey, but Chris, I'm sure back then, with the dollar being the world's reserve currency, there was a flight to safety in the US dollar. Everyone wanted to hoard dollars, and I'm sure the DXY index rallied back then. Well, investors, the answer was no. It played out nearly exactly the same, and the dollar declined almost exactly minus 10% back then during long-term capital blowup. Right now, the DXY declined about minus 10% peak to trough into Friday, April 11th, low hysteria of the dollar demise talk, when only 3 months ago, all I heard in the financial news was how strong the dollar was and how it would hurt companies. I have to laugh. A strong dollar is bad 3 months ago, but now, 3 months later, a weak dollar is bad as well? Okay, back then, back during dot-com, growth was great. I'm sure commodities were doing well. I'm sure oil was fine, but now it's been dropping for almost a year. Big difference, Chris, right? I know you're thinking that. So I looked it up. Take a look at the overlay of oil in mid-dot-com build-out versus mid-AI build-out right now. Pretty much the same. It declined into a long-term market cycle low in October of 1998, troughing just at long-term capital blow-up. It seems to me Friday, April 11th was the likely low in oil for the next 9 to 12 months. Semiconductors, Chris, those have been total dogs now since July 2024. I'm sure they were booming in 1998. I thought so too. I looked back. Nope, they were tanking. It was only in the second half of the dot-com build-out that semiconductors went on wildly higher. But Chris, here we go. The AI bubble has already popped, and Trump tariffs were the final needle that popped it. I mean, Microsoft is already cutting back on data centers. Others will too. Maybe, but when I hear things like demand for new consumer apps like video creation is already melting NVIDIA GPUs due to the demand for inferencing and computational power, I find it hard to believe that the spending is about to collapse. Maybe Microsoft just decided to let some of the AI startups spend up front as they let their own cash flow grow for future AI investments. This is one of the most interesting things I heard last week on CNBC. I can't recall which tech investor said this on TV, but he said, cloud capacity has no natural borders, referring to the borders of countries that are affected by tariffs. Outside of a few countries, do most US companies really care where their data is hosted? Do they care if the data sits in Germany, Japan, Mexico, Canada, or the US? He hypothesized, I believe rightly so, that if on-premise technology costs in the US skyrocket due to tariffs, don't you think this will actually accelerate cloud usage and demand more as US companies defer high upfront CapEx for additional outsourced cloud storage and usage? Yes, I know that earnings visibility is almost non-existent in the short term right now. But remember, stocks are discounting mechanisms that are looking forward into the future. There's a great chart from Josh Brown and another from Michael Batnick and their Irrelevant Investor that reminds investors how far in advance stocks bottom before the economy improves and before earnings visibility returns. Historically, stock prices bottom almost 9 months before their earnings do during bull markets. As long-term investors like to remind newbies, the market doesn't always wait for the all clear. Just look back at COVID or 2022 earnings recession for recent examples. In fact, post-COVID, the S&P 500 was almost 50% higher than its pre-COVID high before S&P 500 earnings bottomed and turned up. If you wait for the all clear on COVID, you are late by 100% of the COVID lows and 50% late on the prior COVID highs. Stocks anticipate turns. We hear a lot from prospects that the markets are too volatile right now. I'm going to wait until things settle down. I get it. When things move fast, it feels horrible. However, historically, this is exactly when individual investors should slowly add to their long-term stock allocations and not retreat. Why? Because time is on your side. Volatility is ramped up because many traders are being forced to sell at lows, being de-risked or being blown out by taking excessive risk at the wrong time. Take a look at this great chart from Jay Capel at Sentiment Trader on 10% 5-day trading ranges, historically marking lows, not highs in the market. As I like to say, they don't liquidate hedge funds at the highs. Investors, regardless of how you look at it or how you're feeling, historically buying the S&P 500 and walking away from weeks like April 11th, you had over a 80% chance of generating an average return of over 17% over the next 12 months. And one final note on volatility creating opportunity for longer-term investors, that is, not hedge funds being zeroed out at the lows. My friend Chris Gallipo and Wakush at Franklin Templeton Research, according to their research, since 1950, the S&P 500 had dropped more than 10% or corrected 38 times. Those are both recessionary periods and non-periods. Investors, on average, those corrections lasted only 44 trading days before the bottom was found and the recovery began. If you don't engage Oak Harvest investment team to help you manage your portfolio besides the S&P 500 index, what would history say you should do? Most likely, buy technology stocks and growth stocks that have been suffering since mid-last year when real growth expectations peaked. Why? Because President Trump just reversed a large part of his draconian tariffs that were going to technology and semiconductor businesses and had been crushing their stocks year to date. A reminder of the percentage of sales outside the U.S. by the index. Mag 7 tech stocks, almost 50% foreign sales. The NDX, technology-heavy index, accounts for almost 46% of its sales overseas. Whether it's foreign government purchases of U.S. technology goods or services, or foreign manufactured and sourced hardware backed by American-designed IP, think about Dell and Apple. Almost 50% of technology sales are made outside the United States. More specifically, in relation to recent announced technology smartphones and electronic exemptions, according to government data, the U.S. imported almost $390 billion of semis and computers last year, including $100 billion, or 23% of total imports from China. According to RAND China Research, the biggest category related to China is smartphones. Last year, the U.S. imported phones worth roughly $41 billion. Smartphones alone accounted for almost 9% of total imports from China. Thank you, Apple. Computer hardware also accounted for $36 billion in 2024. Think of the likes of Dell, HP, and other AI box makers. Altogether, the new exemptions cover semiconductors and consumer electronics worth almost 22% of all Chinese imports last year. Take a look at another great table from Jay that shows the returns from the NASDAQ 100 tech-heavy index after the VIX index crosses back below 45 like it did Friday, April 11th. Yes, you're reading those numbers correctly. A 94% one-year win rate with a 42% average return and a median return of 46.6% at, yes, a very high hit rate. And yes, investors, that does include the long-term capital blow-up time period of late 1998 during .com, like we previously noted. I'll leave you with some more historical data that we shared before the lows late in the week of April 11th that said this was not the time to panic and sell out of your portfolio stocks, particularly if you're working with a financial advisor and have a long-term financial plan that has been stress tested for economic downturns, recessions, and hopefully one-off events like this one. Remember, if you're not working with a financial advisor or you're not happy with the advisor you're working with right now, give us a call. Investors, historic volatility spikes like we just saw are buy and hold points, not pull the ripcord and eject points. Charlie Biello and Creative Planning are always out with great data showing historic 1-year through 5-year forward returns on VIX spikes like these. As we've tried to message many times over the last 7 years, periods of super high volatility have historically been the time individual investors should be investing, not retreating from the long term. Periods measured in years, adding to some stocks slowly and walking away, or dollar cost averaging as your best percentage returns historically have come when putting money into the market during recessions or other economic downturns such as these. No, there hasn't been a lot of good economic news out there from the screens we're seeing. These are definitely the times that are stressful for investors and those cared with managing other savings and financial plans. Can the markets go lower? Of course they can. There are no guarantees in the stock market. But extreme levels of volatility historically, equities being long-term assets whose returns are measured in years, not weeks and months, it's better to add to investments slowly rather than panic and pull the ripcord. Investors, regardless of the path for the economy and the financial markets over the next few months, the investment team here at Oak Harvest will be here, crewing the ship and adjusting our models where we can. Until next week, have a blessed weekend, a happy Easter, and know the Oak Harvest team is doing what we can to plan for you and your financial future, regardless of what stage you're at in your career or your retirement.